Hi, my name is Nur Aina Amira Pintu Samri. I am from JBA1115D. My magic number is 2022641864. So today I will explain on Chapter 1, Introduction to Investments. First one is Basic Concepts of Investment, and the second one is Differences in Investment Goals. So now we go to Basic Concept of Investment. Next, we go to Concepts in Investments. There are three concepts in investment, which is investment, speculation, and gambling. Alright, investment is process of committing funds into one or more assets to obtain return, while speculation means process of committing funds into one or more assets and betting to obtain returns. And gambling is defined as taking something on a contingency, also known as betting or wagering. It means risking money on an event that has an uncertain outcome and heavily involved chance. Okay, next we look on the differences between capital appreciation, income generation, and capital preservation for investment goals. Okay, what's the goal of capital appreciation? The goal is to increase value in investment in the future. Capital appreciation is the difference between the purchase price and the selling price of an investment. If an investor buy a stock for RM 10 ringgit per share, for example, and the stock price rise to RM 12 ringgit, the investor has earned RM 2 ringgit in capital generation. And then when the investor sells the stock, the RM 2 ringgit earned become a capital gain. Okay, next we go to income generation. The goal of income generation is to earn regular income. This strategy aims to generate cash payouts while also potentially growing the capital over time. And the last one is capital preservation. The goal of capital preservation is to protect and avoid loss while generate more returns. This strategy aims to protect an investor capital from market volatility rather than generate large profits.
Hi, my name is Nur Afifa Aisha Mitahir Anwar, and now I'm going to present about the investment ecosystem. So first of all, how does the investment ecosystem work? So the investor or any individual that wants to invest to grow their wealth and earn more money besides working. And then they will start to buy stocks or bonds from the company that they want to invest from the financial market. After that, the investment intermediaries will help the investor and guide them one by one about the investment. And lastly, the regulatory bodies will ensure and make sure the market operating is fairly and there's no fraud happens. So now I'll explain about the financial market, regulatory bodies, and the investment intermediaries that I mentioned just now. Let's start with the financial market. So financial market is basically the platform to start an investment with buying or sell the stocks, such as the stock market like Nasdaq or any other bond markets. This way, it will help to grow their wealth and generate their side income. Secondly, regulatory bodies, which is some type of the institution that supervise and regulate their financial system, like the central bank. They will share the company and investors to follow and gain their shareholder trust. And lastly, the investment intermediaries, which is the individual that helps the investor with the financial market, such as brokers, insurance company, and also the banks.
Factors investors need to consider. The first one is market risk. This is the risk that the overall market will go up or down. Factors like economic events, global politics, or natural disasters can cause market prices to fluctuate. Second, inflation risk. The risk that inflation will erode the purchasing power of your money. If inflation rises faster than your investment returns, the value of your investment could decrease over time. The third one is credit risk. Credit risk that a company or a government you invest might not be able to pay back the debts. It causes to lose part or all of your investment. The last one is interest rate risk. This risk that changes in interest rates can negatively affect the value of your investment, especially bonds. When interest rates go up, the value of existing bonds tends to fall.
Today, I'll be walking you through the major types of investment instruments. Let's start with stock, also known as equity. When you buy a stock, you're essentially buying a small piece of ownership in a company. The risk here is high, as stock prices can fluctuate based on the company performance and market conditions. Next, we have bonds, which are essentially loans you give to companies or government. In return, they promise to pay you back with interest over a fixed period. Bonds generally carry lower risk compared to stocks. Then mutual fund. Mutual fund is a pool money from multiple investors to create a diversified portfolio of assets such as stocks and bonds. The risk depends on the type of asset the fund invests in. The potential rewards comes from sharing in the profit or loss. Next, we have real estate. Real estate involves investing in property, whether residential, commercial, or industrial. The risk comes from factors like property value, fluctuation, and maintenance costs. Then we have commodity. Commodity refers to raw material like wool, oil, or agricultural product. They can be volatile with risk driven by factors like weather and geopolitical events. And lastly, we have cryptocurrency such as Bitcoin. These are digital currency. They are operate on decentralized network. The risk is extremely high. In conclusion, each investment instrument comes with its own risk and reward profile. It's important to assess your financial goal, risk tolerance, and investment horizon before making a decision.
For your information, there are two types of risk. The first one is systematic risk. This affects the whole market like during an economic crisis. And the second one is unsystematic risk. This is specific to one company or industry. For example, like poor management can causing risks in that company. Now, let's talk about risk and return. The first one is low-risk investment, like bonds. They are safer but offer low returns, around 2% to 4% per year. The risk is that their value may drop if interest rates goes up. While high-risk investment like stock, this can give high return around 7 to 9% per year, but they are risky because stock price can change a lot. So, bonds are safe but earn less, while stocks are risky but can earn more. And I think that's all from me. Thank you for watching.